Let's talk about one of the most important words in all of business, revenue. It seems super simple, right? It's just the money a company brings in. But it turns out when a company actually gets to count that money, well, that is a much, much trickier question.
Think about this for a second. You go out, you buy a brand new smartphone, you drop $1,200 on it, and that price includes a full year of software support. So here's the question. Did that phone company just earn all $1,200 the moment you walked out of the store?
You guessed it. The answer is not that simple, and getting it right is a huge deal. It's what separates a genuinely healthy, sustainable business from one that just, looks good on paper for a little while. It's not just about how much money is coming in. It's about when you can truly say you've earned it. To solve this exact problem, all the big accounting brains from around the world got together and created one single unified set of rules. It's a 5-step model that basically acts as a universal language for revenue, making sure everybody, no matter where they are, is playing the same game. On this right here, this is the core principle that drives the whole system. It's a really subtle but powerful idea. Revenue isn't just about the cash you have in hand, it's what you expect to be entitled to based on the promises you made. That one word, expect, it changes absolutely everything. So here it is, our roadmap for this whole process. These 5 steps, they build on each other logically. They take us all the way from just having a deal with a customer to getting that final revenue number on the books. Let's break them down, one by one. All right, let's start with the first 2 steps. This is all about defining the deal. Before we can even think about counting money, we have to know exactly what was promised to the customer in the first place. Step 1 seems kind of obvious, right? Identify the contract. But you have to remember, for an accountant, a contract isn't just a handshake. It has to be an agreement that creates real, legally enforceable rights and obligations. This is the foundation everything else is built on. And to be used for recognizing revenue, that contract has to clear an even higher bar. Everybody has to approve it, the deal has to have a real business purpose, the terms need to be crystal clear, and, this one's a biggie, the company has to be pretty darn sure they're actually going to get paid. Okay, so once we have a solid contract, we move on to step 2, finding the specific promises inside of it. The official term is performance obligations, which is really just a fancy way of saying the to-do list of things the company has to deliver to the customer. And this is such a critical distinction. Think about it. When you buy a cup of coffee, it's simple. You get one thing, one promise fulfilled. But with our smartphone example, it's a whole different story. There are actually 2 separate promises being made. You get the physical phone, and you get a year of service. The company has to track and account for each of those promises separately. So, we've got our contract, we know what we promised to deliver. Now it's time to talk about the money. Steps 3 and 4 are where we figure out what each of those promises is actually worth. Step 3 is to determine the transaction price. This is the total pot of money the company expects to get in return for doing everything it said it would do in the contract. It's the total price tag on the whole deal. So going back to our smartphone, this part's a piece of cake. The transaction price is the $1,200 you paid. Easy enough. But what do we do with that number now? And that brings us to step 4. We have to allocate that price. We can't just throw the whole $1,200 into one bucket called phone sale. We have to split it up between our 2 different promises. And the rule is you have to do it based on what each item would sell for on its own. So if the phone normally sells for $1,000 and the service plan for $200, that's exactly how we slice up the price. All right, this leads us to the final and most important step. We've got our promises, we've put a price on each one. Now we can finally answer that question from the beginning. When does the company actually get to count this money as revenue? Step 5 is where it all comes together. Revenue gets recognized when a promise is kept, when the customer gets control. So for the phone itself, boom, that happens the second you walk out the door. That's at a single point in time. But for that service plan, you receive that benefit over a full year, so the company has to recognize that revenue over time. So the big question is always, when did control officially transfer? Well, accountants have a little checklist. Does the customer have legal title? Are they holding it in their hands? Have they accepted it? If the answers are yes, then the company can book the revenue. In our case, that's $1,000 for the phone, recognized right away. Now, recognizing revenue over time, that's where things get really interesting. Let's imagine a construction company gets a $2 million contract to build a bridge, and it's going to take them 3 years. It wouldn't make any sense for them to wait 3 whole years before recognizing a single dollar of revenue, right? They have to count it as the work gets done. So here's how they might do it. In year 1, they figure out they're about 25% of the way to completing the project. So they get to recognize 25% of the total revenue. A little bit of quick math. That's $500,000 in revenue for the first year. Okay, now let's fast forward to the end of year 2. They're now 60% done with the whole project. That means in total, they've earned $1.2 million so far. But remember, they already booked $500,000 in year 1, so the revenue for just year 2 is the difference, $700,000. And this just keeps going until the bridge is finished and all $2 million have been recognized. So why? Why go through all this trouble? Why is this 5-step process so incredibly important? Well, it all boils down to one simple thing: trust. Trust in our entire financial system. Because these rules exist, it means an investor can look at a company in New York and compare its revenue directly to a company in Berlin or Tokyo and know they're speaking the exact same language. It creates a level playing field, and it's all built on consistency and comparability. So the next time you see a headline screaming about some company's record-breaking earnings, you'll see more than just a big number. You'll see the promises, the prices, and the timing that made it all happen. And you'll know to ask the most important question of all: what's the real story behind how that money was earned?